People come into this game talking about consistency like it's a badge you earn by showing up every day and doing the same thing. Same indicators, same size, same routine. They think the market rewards obedience. I learned early that the market doesn't care how steady your habits are. It only pays you when you're right. Isn't that a hard thing to accept? I've seen men brag about taking trades every single day, rain or shine, as if activity itself were a virtue. But the tape never paid a man for effort. It pays him for judgment. Consistency sounds noble, but in trading it can turn into a quiet trap. How many times have you stayed in a losing method just because you wanted to be consistent? Most traders confuse consistency of action with consistency of thinking. They believe repeating the same behavior will somehow force the market to cooperate. But the market is never consistent. It breathes, it stretches, it tightens. One week it trends clean and rewards patience. The next week it chops sideways and punishes every move. Why would a thinking man stay rigid in a business built on movement? When I was coming up, I learned that my job was not to trade all the time. My job was to wait. Waiting doesn't feel productive, does it? Yet the biggest money I ever made came from sitting still while others burned themselves out chasing every tick. The tape would tell me when the time was right. All I had to do was listen. How often do you actually listen to the market instead of arguing with it? Fake consistency shows up when a trader decides in advance how often he must trade, how much he must risk, and what he must earn. The market never agreed to those terms. It never signed your plan. So when price action changes, the consistent man keeps firing and the thinking man steps aside. Which one do you think survives? You see it clearly on the charts. A stock that's been trending smoothly starts to stall. Volume dries up, ranges tighten. But the trader who prides himself on consistency keeps buying breakouts that no longer follow through. He says setup worked last month. Yes, it did. But this is not last month. Why trade yesterday's market with today's money? There's a difference between discipline and stubbornness, and most traders don't learn it until it costs them. Discipline is knowing your rules and knowing when they no longer apply. Stubbornness is following rules after the reason for them is gone. Have you ever mistaken one for the other? The public loves the idea of steady income from trading, like a paycheck that arrives every week. But the market doesn't distribute money evenly. It gives it in chunks, long stretches of nothing, then sudden opportunity. The man who demands consistency from his equity curve usually ends up forcing trades just to feel in control. And forced trades are expensive trades. Chart reading teaches this lesson better than any book. Look at a real trend. It doesn't move in a straight line. It surges, pulls back, rests, then moves again. The money is made in the surge, not in the boredom between them. Yet most traders try to trade the boredom because they feel uncomfortable doing nothing. Does that sound familiar? I always believed that my capital was my inventory. You don't waste inventory just to stay busy. You deploy it when conditions favor you. Fake consistency encourages wasting capital on low-quality situations. Real professionalism is knowing when not to trade. Isn't that the part no one brags about? Your mindset matters here. If you tie your self-worth to daily results, you'll crave consistency even when it hurts you. You'll feel pressure to prove something to yourself or others. But trading isn't a performance. It's a business of positioning yourself for the few moments that matter. Can you handle waiting for those moments? Risk management suffers under fake consistency. A trader who insists on the same position size in every market condition ignores volatility, structure, and context. When ranges expand, his size is too big. When ranges shrink, his trades go nowhere. The market changes speed, but he refuses to adjust. Is that discipline, or is it laziness disguised as principle? I learned to scale my aggression with clarity. When the tape was clear, I pressed. When it was cloudy, I backed off. Some weeks I barely traded at all. Other weeks I made more than I expected. Over time, that uneven approach produced steadier results than any rigid routine ever could. Funny how that works, isn't it? Wealth in trading isn't built by constant motion. It's built by selective action. The great moves don't happen every day, and they don't announce themselves with comfort. They appear when most people are tired, bored, or licking wounds from trying too hard. Are you still sharp enough to act when that moment comes? Fake consistency also blinds traders to learning. If you believe your edge must work all the time, you stop questioning it. You stop adapting. You defend your method instead of studying the tape. The market evolves, but you don't. And the market always wins that fight. A man who wants to grow capital must grow judgment first. Judgment isn't consistent in appearance, but it is consistent in intent. The intent is to protect capital, wait for alignment, and strike without hesitation when the odds lean your way. That kind of consistency doesn't show up on a daily trade log, but it shows up in long-term survival. So when you hear someone preach endless consistency, ask yourself what kind they mean. Is it the shallow kind that demands action, or the deeper kind that demands patience and restraint? The market has no respect for slogans. It only respects those who adapt. And that's where most traders stop thinking, right when the tape is about to teach them something important. The market changes character faster than any fixed routine can keep up. And that truth cost me more money than any single bad trade ever did. Early on, I believed that if I found a method that worked, my job was simply to repeat it. Same entry, same stop, same exit day after day. It sounded sensible, it felt safe. But the market has never rewarded comfort. Have you noticed how the very thing that works best suddenly stops working when everyone gets used to it? A market is not a machine. It's a living thing made up of fear, hope, impatience, and greed, all shifting minute by minute. 1 month it trends smoothly, respecting levels like a gentleman. The next month it whips around violently, breaking every obvious setup and punishing the very habits that were profitable before. A fixed routine doesn't read character, it assumes character, and assumption is expensive in this business. When volatility expands, price starts covering more ground with less effort. Breakouts become violent, pullbacks get shallow or disappear altogether. A routine built for quiet conditions suddenly carries too much risk. Stops get hit faster, positions feel heavier, yet the trader who worships routine tells himself to stay consistent. He trades the same size, the same way, and wonders why the market feels hostile. Have you ever felt like the market turned against you overnight? Then there are slow markets, tight ranges, false starts, price drifts instead of moves. A routine designed for fast trends now starves. Trades go nowhere. Time becomes the enemy instead of price. The consistent trader keeps firing because that's what his schedule demands. But the market is not on his schedule. It never has been. I learned to judge the market the way a sailor judges the sea. You don't sail the same way in a storm as you do on calm water. You don't insist on the same speed, the same sail, the same course just to prove you're disciplined. You adapt or you sink. Why should trading be any different? Charts reveal character if you study them honestly. Look at how price reacts to bad news. Does it collapse or does it refuse to go down? Look at how it responds to good news. Does it explode or does it stall? Those reactions tell you more than any indicator ever will. But a rigid routine often ignores these clues because they don't fit neatly into rules. Are you trading rules or are you trading the market? Fixed routines also ignore time. Markets move in phases. Accumulation, expansion, distribution, contraction. Each phase rewards a different behavior. Accumulation punishes impatience. Expansion rewards decisiveness. Distribution traps the latecomer. Contraction grinds down the overactive trader. A routine that doesn't account for phase is blind by design. I've seen traders who were brilliant trend followers get destroyed in sideways markets because they refused to slow down. I've seen scalpers bleed slowly during strong trends because they kept taking profits too early. Their routines were consistent. Their results were not. Isn't that the irony? The market doesn't ask for loyalty. It doesn't reward persistence for its own sake. It rewards alignment. Alignment with direction, with volatility, with participation. When those elements line up, trading feels almost effortless. When they don't, every trade feels like work. A fixed routine keeps you working even when alignment is gone. There's also a mental cost to rigid habits. When a trader expects his routine to work and it doesn't, frustration builds. He starts blaming execution, then psychology, then luck. Rarely does he blame the routine itself. His identity is tied to it. Letting go feels like failure. But adaptation is not failure. It's survival. Money mindset matters here. Traders who think in terms of daily income crave predictability. They want the market to behave so they can feel secure. But markets are not designed to provide emotional comfort. They are designed to move capital from the impatient to the patient, from the rigid to the flexible. Can you accept uncertainty without trying to control it? I learned that consistency belongs in preparation, not execution. Consistent study, consistent risk awareness, consistent respect for the tape. Execution must remain fluid. Size must breathe. Frequency must change. Some days demand aggression. Others demand restraint. A routine that ignores that reality is fighting the very structure it depends on. When I stopped forcing myself to trade the same way every day, my results became steadier, not because I traded more, but because I traded less when conditions were poor. That's the part most people miss. Fewer trades, better alignment, clearer conviction. Consistency of judgment replaced consistency of habit. The market's character is written in price action, volume, and behavior around key levels. It whispers before it shouts, but a fixed routine often drowns out those whispers with rules and checklists. You follow the routine, miss the message, and pay for the privilege. Every great move I ever caught required me to abandon routine in favor of observation, to wait longer than usual, to size differently, to act decisively when the moment arrived. Those moves never fit neatly into a daily schedule. They arrived when they were ready, not when I was. And that's the lesson most traders resist, because it demands humility. It demands admitting that the market leads and you follow, that your routine is a tool, not a commandment. Equity curves are uneven because opportunity is uneven, and that is something most traders refuse to accept at the start. They look at a chart of their results and expect a smooth upward line, as if money were earned the same way interest accumulates in a savings account. But trading is not a savings account. It is closer to hunting. Some days you see nothing. Other days everything lines up at once. Have you ever noticed how the market seems silent for weeks and then suddenly alive? The trouble begins when a trader believes his equity curve should rise a little every day. That belief quietly shapes his behavior. On slow days he feels pressure. Pressure to trade. Pressure to make something happen. And when nothing is happening in the market, that pressure turns into mistakes. Losses taken not because price demanded them, but because the calendar did. Markets do not distribute opportunity evenly across time. Trends cluster. Volatility clusters. Participation clusters. There are periods when the tape offers clean, readable moves with room to breathe. Then there are long stretches when price chops, fakes, and tests patience. The equity curve reflects that reality. Smooth curves are usually a sign of overtrading or curve fitting, not mastery. Doesn't that run against what most people are taught? When I studied my own results honestly, I saw something uncomfortable. A large portion of my profits came from a small number of trades. The rest were noise, break even, small losses, small wins. The temptation was to smooth that out by trading more often, but that would have meant trading lower, quality situations just to satisfy my desire for balance. Balance is a nice word, but the market doesn't care for it. A trader who understands uneven opportunity learns to value inactivity. He doesn't measure his success by how often he trades, but by how well he trades when it matters. That shift alone changes the equity curve mindset. Drawdowns stop feeling like failure and start feeling like waiting. Can you tell the difference when you're living through it? Most equity curves look ugly in real time. They dip, they stall, they frustrate. Only in hindsight do they appear clean. But traders experience them forward, one trade at a time, without knowing when the next opportunity will arrive. That uncertainty is what drives people to force consistency where none exists. Think about strong trends. They don't appear gradually. They often begin after confusion, after false moves, after traders are worn down. When they finally break, they move fast and far. Those moves can account for weeks or months of progress in a short span. The equity curve jumps. Then it goes quiet again. That's not a flaw. That's the structure of the business. The public wants trading to look professional, orderly, predictable. They want daily goals, weekly targets, monthly guarantees. But the equity curve refuses to cooperate. It reflects the reality that money is made when conditions align, not when the clock says it's time. Have you ever tried to trade well just because it was Monday? Uneven equity curves also test risk management discipline. During flat periods, the urge to increase size or frequency creeps in. During winning streaks, overconfidence follows. Both distort the curve further. The trader who understands uneven opportunity adjusts behavior instead of fighting the curve. He risks less during uncertainty and presses only when clarity returns. There is also a psychological trap hidden in smooth expectations. When traders expect steady progress, they interpret any drawdown as a personal flaw. They start tinkering, changing systems, adding indicators, searching for a method that will work all the time. But no method works all the time because opportunity does not exist all the time. Isn't it strange how often people blame themselves for the market's silence? Wealth building through trading requires a long view. Capital grows in bursts. The equity curve steps upward, not ramps. Each step is earned during a period of favorable conditions. Each flat section is survival mode. The trader who respects that structure preserves capital during the flat, so he's fully present for the steps. Charts teach this lesson if you look closely. Pull up any market over years, not days. You'll see extended consolidations followed by explosive moves. Price spends far more time resting than moving. Equity curves mirror price behavior because trading is simply participation in price behavior. Expecting otherwise is denying the very charts you claim to read. The uneven curve also protects the disciplined trader from envy. When you know that profits arrive irregularly, you stop comparing yourself to others posting constant wins. You realize that many of those smooth curves are illusions, created by selective reporting or hidden risk. Real curves wobble. Real traders endure boredom and doubt between moments of clarity. I learned to judge my performance not by short-term smoothness, but by long-term survival and growth. Did I protect capital during dull markets? Did I recognize opportunity when it returned? Did I act decisively instead of hesitating because I had grown comfortable doing nothing? Those questions mattered more than daily profit totals. The market has a way of rewarding patience in uneven ways. It starves you, tests you, lulls you into overconfidence, then suddenly offers a chance that demands full commitment. The equity curve jumps only if you are ready. If you spent the quiet time chasing consistency, you arrive exhausted and undercapitalized. Accepting uneven equity curves requires emotional maturity. It means being comfortable with stretches where nothing improves. It means trusting your judgment without constant reinforcement. It means understanding that doing nothing can be the most profitable action for long periods. Forcing trades is usually a response to ego, not price, and that's a lesson the market teaches slowly and expensively. Price never begs you to act. It never pressures you. It simply moves or it doesn't. The pressure comes from inside the trader, from the need to feel active, to feel right, to feel in control. Have you ever entered a trade knowing, deep down, that the chart hadn't really earned it? Most forced trades begin with discomfort. The market is quiet. Setups are unclear. Nothing lines up the way it should. Instead of accepting that condition, the trader starts negotiating with the chart. He lowers his standards. He reinterprets signals. He tells himself the move is close enough. That's not analysis. That's ego looking for validation. Ego hates waiting. Waiting feels like weakness to the undisciplined mind. It feels like falling behind while others are making money. But price doesn't reward urgency. It rewards alignment. When a trader forces a trade, he's not responding to opportunity. He's responding to emotion. Usually boredom, impatience, or the desire to recover a loss. Isn't it interesting how those trades rarely feel calm? Charts are brutally honest. They show structure or they don't. They show expansion or contraction. They show acceptance or rejection. A forced trade ignores those facts and replaces them with hope. Hope that this time will be different. Hope that the market will move simply because you entered. But the market doesn't know you exist. I've noticed that forced trades often come with extra thinking. Too many reasons stacked on top of each other. Too much explanation for a simple decision. Clean trades are quiet. They don't require convincing. When price is right, the trade feels obvious. When it isn't, the mind starts working overtime to justify action. Have you noticed how noisy your thoughts get right before a bad trade? Ego also shows up after losses. A losing trade bruises identity. The trader feels the need to prove something to himself or to the market. He wants to get the money back quickly, cleanly, decisively. That desire pushes him into the next available setup, not the right one. The chart becomes a tool for emotional repair instead of decision-making. Forced trades usually ignore context. They focus on one candle, one indicator, one level, stripped of the bigger picture. The trader zooms in to avoid seeing the truth. Maybe the market is ranging. Maybe volume is dead. Maybe higher time frames disagree. Context would suggest patience, but ego demands action. There's also a subtle form of forcing that looks disciplined on the surface. Trading because the plan says to trade. Same time every day, same number of trades, same routine regardless of conditions. It feels professional, but it's still ego-driven. Ego wants predictability. It wants structure that makes it feel safe. Price doesn't offer that comfort. The market never asked you to trade today. That's a hard sentence for many traders to hear. They treat trading like attendance-based work. Show up, put in effort, get paid. But trading doesn't work that way. You get paid for being selective, not for being present. Can you show up without needing to act? Money mindset plays a big role here. Traders who tie self-worth to activity struggle the most with forced trades. Doing nothing feels like failure. Waiting feels like wasted potential. But capital preservation is progress, even when the balance doesn't change. Ego doesn't see that. Ego only sees action. When I reviewed my worst trades, they shared a pattern. They were unnecessary. The market wasn't offering anything special. I wasn't particularly clear. I just wanted to be involved. Those trades didn't come from insight. They came from impatience disguised as confidence. The danger of forced trades is not just the loss itself. It's the erosion of trust in your judgment. Each forced decision blurs the line between real signals and emotional impulses. Over time, you stop knowing why you're entering trades at all. The process becomes reactive instead of deliberate. Price action has a rhythm. When you're aligned with it, you feel in sync. Entries make sense. Risk feels contained. When you're forcing trades, everything feels slightly off. Stops feel too close or too far. Targets feel uncertain. You're managing anxiety instead of risk. That's not trading. That's coping. The market is patient. It will wait you out. It will let you overtrade, overthink, and overcommit until you're tired. Then, when the real opportunity arrives, you'll hesitate because you've spent your focus and confidence on meaningless action. That's how ego quietly sabotages profitability. Restraint is invisible, and that's why ego resists it. No one sees the trades you didn't take. No one applauds patience, but the equity curve remembers. Capital remembers. Over time, the trader who avoids forced trades finds himself sharper, calmer, and ready when price finally speaks clearly. The hardest part is learning to sit with the urge to act and letting it pass, to feel boredom without trying to escape it. To accept that some days are meant to be observed, not traded. Ego interprets that as weakness, but the market interprets it as professionalism. Every clean trade begins with permission from price, not permission from emotion. And most days, that permission never comes. Rigid systems fail when volatility and structure shift, and they fail quietly at first. Not with a dramatic blow-up, but with small losses that don't make sense. Trades that almost work, moves that start and then die. The trader looks at the chart and wonders why the same setup doesn't feel the same anymore. Have you ever said to yourself, "This should be working"? A rigid system assumes the market behaves within fixed boundaries, fixed ranges, fixed responses, fixed probabilities, but the market never promised that. Volatility expands and contracts like breathing. Structure evolves as participants change their behavior. Institutions step in, then they step away. Liquidity appears, disappears, reappears somewhere else. A system built for one environment slowly becomes outdated, even if the rules remain perfectly followed. When volatility is low, price moves gently. Breakouts need time. Stops can be tighter. Patience is rewarded, But when volatility expands, those same stops get swept without warning. Price travels farther, faster, with less respect for minor levels. A rigid system keeps doing the same thing and calls it discipline. The market calls it easy prey. Which one do you think gets paid? Structure matters just as much as volatility. A clean trend has rhythm. Higher highs, higher lows, pullbacks that hold. A range-bound market has a completely different personality. It fakes, traps, rotates. A system designed to follow trends will bleed in ranges. A system built for ranges will get steamrolled in trends. Yet rigid systems pretend structure doesn't matter, as if one logic can rule all conditions. Most traders don't notice the shift right away. That's the danger. The system still produces trades. Signals still appear. Losses are manageable, but confidence erodes. The trader starts trading smaller, hesitating, second-guessing. He thinks the problem is execution or mindset. Rarely does he question whether the environment has changed. Have you ever blamed yourself for something the market changed? Rigid systems also create a false sense of security. Clear rules feel safe. Mechanical entries feel professional. But safety in trading comes from awareness, not repetition. A system that doesn't account for context is like a map that never updates. It might have worked once, but roads change. I've seen traders cling to systems the way gamblers cling to lucky rituals. Same indicators, same settings, same time frames, year after year. They adjust nothing because adjusting feels like admitting the system isn't perfect. But no system is perfect. Markets evolve because participants evolve. Capital flows change. Regulations change. Technology changes. Why wouldn't structure and volatility change with them? Charts always show the truth if you're willing to see it. Candles get larger, wicks get longer, overlaps increase. Or the opposite happens, movement dries up, breakouts lose follow through. Those are not random events. They are messages. A rigid system treats them as noise because they don't fit the rule book. The danger is not just losing money. It's losing sensitivity. The trader stops reading price and starts reading signals. He waits for permission from his system instead of permission from the market. When structure shifts, his system reacts late, and he follows even later. By the time the system adapts, the opportunity has already passed. Volatility shifts also affect risk in ways rigid systems ignore. A fixed stop distance means different things in different environments. In quiet markets, it's generous. In volatile markets, it's reckless. Yet the rigid trader insists on sameness because it feels fair. The market does not operate on fairness. Rigid systems fail hardest during transitions, the moment when the market stops trending and starts ranging, or stops ranging and begins to trend. Those transition zones are where judgment matters most. A system built on fixed conditions doesn't recognize transitions. It only recognizes patterns that already existed. Do you see the problem? The irony is that systems are meant to reduce emotion, but rigidity often increases it. When trades stop working, frustration builds. The trader follows the rules and still loses. That feels unjust. Anger replaces curiosity. Ego replaces observation. Instead of adapting, the trader doubles down, convinced the system must work again. Adaptation doesn't mean abandoning structure. It means understanding when structure changes. It means adjusting expectations, size, frequency, or even stepping aside. Rigid systems don't step aside. They keep firing. They don't know how to wait. The market rewards flexibility wrapped in discipline. Not chaos, not impulsiveness, but informed adjustment. The trader who survives learns to ask different questions. Is volatility expanding or contracting? Is price respecting levels or cutting through them? Are moves clean or erratic? Those answers matter more than whether a signal appeared. Rigid systems fail because they treat trading as static, but trading is dynamic participation in a moving environment. Every day you show up, the market is slightly different, sometimes dramatically different. Ignoring that reality doesn't make you disciplined. It makes you disconnected. I learned that systems are tools, not authorities. They help organize thinking, not replace it. When volatility shifts, I shift. When structure changes, I change with it. Some days the system stays in the drawer. That choice saved me more money than any rule ever did. The hardest part for most traders is letting go of certainty. Rigid systems promise certainty. Follow these rules, get these results. But certainty is an illusion in markets built on probability. Flexibility feels uncomfortable because it demands awareness and responsibility. You can't hide behind rules when you adapt. Markets don't break systems. Systems break themselves by refusing to acknowledge change. Volatility will expand whether you want it to or not. Structure will shift whether your rules allow it or not. And the trader who insists on sameness in a business defined by change eventually learns that consistency of rules without consistency of awareness is not strength. The market never stops moving, even when your system does.